Hey guys, it's Dave. We may actually be at the end of the Fed's tightening cycle. The Fed is meeting today, Tuesday, May 2nd, and tomorrow, May 3rd, and will announce what is expected to be a 0.25% hike to the federal funds rate, bringing it up to 5%. Now, this doesn't mean much to most people, but this has been what their efforts have been to reduce inflation, and it is the fastest that they have raised federal interest rates, the highest in the shortest period of time in history. It's interesting to see that if you look at the history of the federal funds rate, this line here is 5, and most of the 70s and 80s we spent above that line. We're barely going to get to 5, and it feels like the world is going to end with interest rates being through the roof at 6% plus, and credit card rates and stuff. People are really struggling right now when this was kind of the normal Fed funds rate for almost 2 decades. We also spent the second half of the 90s above the 5% rate, but ever since 2001 with the dot-com bust, and then of course the end of 2007 with the great financial crisis, we have been addicted to stimulus or artificially deflated interest rates. And then when we tried to kind of bring things back up in 2018, Donald Trump threw a fit, and the Fed pivoted and brought rates back down. At least they were starting them back down. And then, of course, we had the pandemic, and we know how that goes. So it's interesting to see if we have spent too long in the overstimulated economy that has caused this inflation. And then it also shows that maybe we don't know how to survive as an economy without artificially low borrowing costs. So this information that's coming out tomorrow, there's an 85+% chance that they will raise it 0.25%. And then almost everybody and their brother feels like that's going to be it. And they will take more of a wait and see. They're going to look a lot at what the Fed's statement is and what their forecast is. It's going to say something like, we will be data dependent on future rate hikes and take adjustments as necessary. But most people feel like the adjustments that they've made have a lagging effect. And so we haven't quite yet seen the effect in the economy from rate adjustments that they've done 6 months ago. So we may see inflation continue to drop, and there to be more and more layoffs that are kind of already built into the system. And many people fear that any future rates will just continue to do more and more damage that won't be felt until later on down the road. So you can see that there's an 83.5% chance of adjustment tomorrow. And then in the June meeting, they're expecting, actually, most people think, a slight drop. This number is because they're polling a lot of economists and they're taking an average. They're not going to lower it negative 5.8%. Nobody's voting for that particular one. It's just when you average everybody out, this looks like a pause. And kind of looking at it in graph form, here we are at 4.8 now, going to the 5 or 5.25, however that adds out. And then in June staying the same, and then the odds of drops really start to increase. This is July, this is November, and so you're starting to see that we could potentially be down. This is 4.2, potentially bring it down almost 1% by January, the end of January of next year. Now this chart, and of course this is economists predicting things, and it's a lot like the weather. It's easier to see close in, but who knows what the weather is going to be like when we get further down the road. And as we go along, we'll be able to kind of have more clarity as to what inflation is doing, what the unemployment rate is doing, and then the Fed will make those adjustments as necessary. Now, this has a lot to do with mortgages because the federal lending rate is how banks borrow money from each other, and bonds are tied to that. The 10-year treasury is tied to that because they're all competing for long-term investment and guaranteed income on these returns. So if you see the Fed funds rate lower, you should see mortgage rates, 10-year notes follow suit. But I don't know this time because we're in kind of uncharted territory where, like I said, 5% used to be no big deal, and now it feels like they're breaking the economy when they bring it to 5%. And doing it so fast when a lot of the indicators that they use to see if they're successful are lagging. Rent and home prices, a home price takes 60 days before you actually see a closing come in. And so you're a couple of months lagging on what the effect is in housing. Same with rents. The data that the Fed uses is outdated. And so there's other more modern ways to measure the impact of these rates that show that a recession may already be here, that they've gone too far, and we could be in a little bit of trouble. They could pivot and start dropping that rate like this chart shows within a couple of months if the data gets bad. So it'll just be interesting to see how that all shakes out. I'll probably do a video tomorrow on what they actually did and see how things shake out. Stock market didn't like how things are going. We just had another bank failure. And so that's concerning. A bunch of the smaller banks had their stock prices go down 10, 20% today. These are the regional banks. And so there's still more damage, I think, that might have to work itself out. And then the Fed might have to pivot and start dropping rates. I'm really hoping they do that quickly because they could have damaged this economy without knowing it, again, because of the lagging data. But hopefully they will reverse as needed and quickly if we start to see more of a ripple effect of these bank failures, the high credit card balances, and other things like that that are hurting the American consumer. Jobs are still holding in. The unemployment rate is really good, but we do have a job report coming out Thursday after the Fed releases their rate hike. So we'll see if the job market stays strong. We need that. Housing market is holding in there. We had the initial drop, but things have leveled off. Activity is still slow, but prices are holding. And we'll just have to see what the future holds. That's really all I've got for you today. If you like more content like this, please subscribe and let me know if you need anything answered in the comments below. I'll be reading those. Thanks a lot for watching. Take care.